Mike Bossy has been a trusted business advisor to clients for over 35 years. Mike is a strategic thinker and combines his extensive experience as a chartered professional accountant with other select business designations to provide a spectrum of value-added services. These services include accounting, trust, and estate planning, taxation, and business consulting, with particular emphasis on intergenerational businesses and farm transfers. Mike is a graduate of Western University's Ivy Business School and is a chartered professional accountant. He is also a certified agricultural farm advisor, Colby certified consultant, and a Colby certified youth specialist. Part of Mike's commitment to continuing education and professional development includes participation in the strategic coach program. Mike is the founder of what is now BNG, Bossy and Aggie Group Professional Corp, with head office in Tillsonburg. He is joined first with Steve Nagy and later other partners, forming a professional service firm dedicated to helping clients build better businesses. BNG has also grown to a team of over 50 members in 3 locations in southwestern Ontario. Mike has spoken professionally on the Colby system and has also developed and delivered the Advanced Farm Management Program. He is an energizer of people and a source of pragmatic, creative solutions to issues that are seen as opportunities rather than problems. Welcome, Mike.
Oh, mine's a bit of a collection of a whole bunch of different ideas and concepts, and there's a lot of material in here, and you can do a deep dive of all this stuff. But I always like to lay my topics over top of the family farm transfer matrix, just because when you're doing that kind of work, all kinds of other things pop out that are opportunities for improvement or opportunities for growth. So when I look at family transition, 2 things: you can deal with things in the past and you deal with things in the future. So in the past, if you spend all your time on the past trying to make the past better, you never can go ahead in the future. So when I look to the past or the school of transactions that you might go through, it's when something happens to you, it's either a win or it's a learning experience. And if you're still hanging on things in your mind that happened in the past, it means you haven't learned the lesson yet. So you take that stuff in the past. So oftentimes when I get in family farm transfer work, people are worried about all the past things. So they're worried about someone else's mood and personalities. They're worried about someone else's core values and beliefs. So I like to move them over to the right side of this little chart, where into a thing where I call it's a basically future normal with the vision and mission. And then based upon a bunch of facts that the down low about your farm, then we can put some structures in play. So the rest of this topic is going to be just talking about some financial key points to take away as it relates to your own financial information. Now, there was a survey done in 2015, but it's still relevant today, and it was proven statistically valid. But they did a survey of all producers across all agriculture industries, and they found that farmers in the bottom quartile of that were 3 times more likely not to seek out new information, not to get training, not to learn, not to constantly and never-ending improvement. Another thing that popped out was that producers who use detailed financial records in their management decisions made better results. So the farms in the bottom quartile were 3 times more likely not to use their regular basis for decision making, not to monitor their cost production, as Melvin mentioned, the cost of production, and then also benchmarking against other producers to see where the opportunities might lie in your own operation. The third thing was the use of business advisors. Now, Melvin ranked his feed guy ahead of his accountant, when I'm hurt by that comment. But anyway, I'm just kidding, but it's your advisors become a very important thing. So the farmers that were in the top quartile were 30% more likely to work regularly with trusted advisors or a team of advisors. And then lastly, the other big takeaway was that farms in the top quartile were more likely to have actually written down what their farm looks like in the future. So without a compelling future, it's hard to move forward. And if you look at planning horizons, if you said, I can give you all kinds of time to do a planning, but if you looked at a 25-year horizon, doesn't mean you have to know exactly what's going to happen over the 25 years. You only have to focus on these first 90 days and get five things done in those 90 days that move you forward into the future. And a 25-year period says there's 100 of those quarters where you can be getting a little bit better. And if every quarter you improve 1% in that, by the end of that 20 times or 25-year period, you'll be actually 10 times as big, 10 times as profitable, 10 times all kinds of stuff. Other things that I see people, the farmers struggle with is the method of accounting they use. And Amanda will likely talk about this, but you know, what are your financial, how you prepare your financial statements? Are they on an accrual basis where you're trying to match the revenue you earn with the expenses to earn that revenue? Or is it just a tax statement where everything is you know, on a cash basis, and you don't get a clear picture of actually how you're doing? So your income statement, whether it's monthly, quarterly, or yearly, all businesses basically run the same way. They all have the same thing. Like even ours, we try to be a low-cost producer, and by that I mean we don't try to be cheap, but we're trying to seek value. We create a culture inside of that where we're trying to seek, the culture itself is seeking to have good value. We invest in things that will make our things faster, easier, cheaper, bigger, better. And whatever assets we have, like we try to use them 100%, and on the farm, it works the same way. So your income statement that you're pulling off, there's all kinds of places where you can act as manager. So on the revenue side, revenues are always a quantity sold by a price, and you as management can interact with that. Similarly on the expense side, changing the amount you bought. Did I get it at a good price? What happens if I bought it in bulk? What happens instead of two loads of, I don't know, brewer's grain, let's say, for example, I took 4. Now that might involve some storage, but again, it's thinking about how to lower that cost per unit. And then of course you have to worry about your overhead, and all those things are management places to interject as a manager. So one of the benchmarking tools, or one of the key things that we try to emphasize, and there's hundreds of different things called ratio analysis, but ratios are numbers that are divided by each other, are you know, a surplus of something or whatever, but it's the trends in those ratios that highlight for you valuable information about where you're heading. You look for trends. You know, am I ahead of my trend, or am I behind it, or wherever? But you use those ratios to manage your business. Now, the place I would start, just as a piece of advice, is I would call my lender and find out what ratios and things do they look for in the beef business. I mean, it might be feed gain per day or whatever, but you know, what ones does the bank look for ratios? Is there debt servicing one? Is there a debt per acre? Is there a debt per animal? It's find out from them what you have, and those should be in your toolbox, so that you should understand them, how those ratios interact and how to use them. Now I'm going to talk about a couple favorites of mine, and they show up quite common, but the first one is what's called financial efficiency. So financial efficiency is a ratio that measures on a percentage basis, how much does it cost me to make $1 worth of revenue? And when I do that analysis, so for example, if I took all my beef farmers and I did all that analysis, I would take out anything that would be reflective of how large your farm is as far as expense. So I take out depreciation or amortization because you don't write a check for that. I take out long-term interest. I take out rents. I take out property taxes. I take out family wages. And then I can compare all my producers in that kind of what beef or dairy or whatever it is, based upon how much does it cost me to make $1 revenue. And the lower that percent is, the more financially efficient you are. So then if I take my financial efficiency and say, all right, I get this surplus, and we'll talk about a thing called EBITDA in a second, but I take my surplus, where can I use that surplus? Basically 4 areas. You can pay interest, rent, and pay your leases. You can pay back principal. You have to live, your owner's draws, and then what's left in the end is what's left over for growth. And then something that Melvin talked about or was asked about was, how do you manage how is risk managed? So if we look at just a real simplified example. So here is a chart, and then here's the different efficiencies across the top, 30, 40, 50. Assume this farm has 300,000 of revenue, and I'm not changing that at all in all 3 columns. And this here one says I got a 30% efficiency. So what's 30% of 300? Well, it was 90. So I have $210,000 left over to use in those 4 buckets that I used on the previous screen, right there. So they're there for that, to use my funds for those 4 buckets. So here I just arbitrarily say, all right, I got $210,000. Well, then I can have, if 25% went to interest, 25% went to living, 25% to my rent, principal, and leases, and then the rest was for future growth. And I said, okay, let's assume that my efficiency then dropped to 50%. Well, now I only have 150. So when I do the 25% across all the 4 buckets, realistically, is it likely that my interest cost is going to go down? No, because I've got my lender and I have agreed that my principal and interest will stay the same, so that interest stays the same, principal would say, so I can't adjust those. Risk suffers because there will be less money left over for risk, and it's really hard to adjust your living downwards. I don't see it happen too often, where when things are going well, everybody's living ratchets up, and it's a hard conversation to have with clients when they're kind of overspending. And I tend to use this chart to say, well, what happens if your efficiency drops? Are you prepared to take a reduced amount of living? So oftentimes that's a very difficult conversation, but it has to be done. The other thing I just mentioned was the thing called EBITDA, which, and again, go to your banker and ask them to define that for you, because in your condition letter, the 1 page, it's not really a summary. Usually they can be like 5 to 20 pages long every year if your banker, and I know Amanda does it. They give you this is a summary of your loans and your interest and your collateral and your commitments and covenants, and this is the ratios we're going to use, and there's a whole bunch of things in there that you have to pay attention to. But there may be in your banker's covenant letter, I call it, a definition of what EBITDA is. So get that definition. So sometimes it involves leases and rents and family wages, adding them back as well. And maybe Amanda can comment on it later, but there's a thing called unfunded capital expenditures. Farmers are somewhat notorious for using their operating line to buy equipment. And there's reasons that happens, but again, if you didn't get any long-term money to fund the purchase of a capital item, that's what they refer to as an unfunded capital expenditure. So spend some time with the banker, understanding how he calculates those measurements. There'll definitely be somewhere a thing called a debt servicing ratio or covenant or what surplus, where based upon EBITDA, they'll do a calculation with, if I have, what's the ratio of surplus I have to the amount of principal and interest I have to pay. and they'll give you guidance on that, or not guidance. They'll just say what it is. So you'd have to understand that, because that ratio links your income statement, profit and loss, to the balance sheet. So important to look at that, because it does have an impact on your, long-term solvency. So you want to check your health, ask them what this ratio is. There's a thing called 8 C's of credit, but I'm not going to go through them all. Some people say there's 5, some 6. I mean, there's all kinds. I like the 8 one, but basically it's, your character. And what I'd say there is your character is your word good when you give it? Do you show up on time, finish what you start, say please and thank you, be appropriate, all that kind of stuff. It's in there. Capacity is your ability to pay. Collateral is what do you got for security. Capital is how much money you got into it. What conditions is what's going on in your industry. Compliance, are there certain things that the bank requires, or maybe your other shareholders require? Are you in compliance with that? Coverage has to do with interest. And confidence. Now, I had confidence because you get confidence by learning from the past and any mistakes you made. You get confidence by improving how much knowledge you know about your business and industry. I mean, I had a hard time following Steve there earlier because I had to really think about some of the things that were on that chart, but those were important that you understand that. So you kind of, at the end, you take all this stuff that you learn from your banker and your accountant and things like that, and you put it into a scorecard, and you can set that scorecard up any way you want. So this one's a historical scorecard. So you might want to know about my total revenue. This is a dairy example, but something that's important to them is age of first calf heifers, debt load per unit of production. What is your unit of production that you want to use? There's surplus in the operation, EBITDA less my living, my operating efficiency, working capital. So you build this and you can start to see trends. And some of these scorecard things can actually be calculated every day if you chose to. Some of them lend themselves to that. So then you have an action plan. So let's say you had some ratios, today's figures, target figure, some future date. Then what kind of tactics do you follow to get your financial ratios where they need to be? So I'm going to summarize what all these things kind of talk about. Some of my rules, I call them top 10, but it's I only call them top 10 because I think that's what Jay Leno called them, or what was the other guy that was a comic. But anyway, he had the top 10 all the time on his show. So the first one is, as humans, we do more to avoid pain than we do to gain pleasure. So if it's painful talking to your banker because things are starting to go sideways, you tend to put it off. It's better to switch that around. So be a star and let them know what's happening. My experience is that you get money from a lender and then you don't hear from he or she does not hear from you for a long time. Well, human nature says, oh, I wonder what's going on. I wonder if everything's okay. All right. So again, make the conversation. Read that condition letter, all the rules. Most of the time when we're dealing with some producers, all they're worried about is the interest rate. Well, there's more to the interest rate there's more to that condition letter than just the interest rate. There's the conditions that I met, the compliance features, the monthly charges, the setup fees, is there appraisals needed? There's all kinds of other things that are in there that your banker is willing to discuss with you. The price question, and money is a commodity, and there's a bunch of other value-added things that come from your lender. We tend to have a tendency to just look at money as a cost. And so when we're not sure of something, we will sometimes ask the question. The only question we ever ask is, what's the price? Because you don't know what question to ask. A better question to ask your lender is, how do you set my price? I see a lot of people will go in and say, oh, my neighbor gets prime, why don't I get prime? Ask your lender. I have yet to meet a lender that does not tell you how he or she will set your price. So that's what I mean by ask the different question. Remember the 5 C's, 6 C's, whatever out of that bucket I gave of 8, which one you want to choose. Referability habits are the things that relate to showing up on time, please and thank you, finish what you start, do what you're saying you're going to do, and then also be appropriate. 6, if you haven't heard from your lender, give them a call. Take him or her out to lunch. Matter of fact, if you do that, they'll probably pay for lunch. Covenants, what are yours? Do some planning, strategies, and transitions. Can I? That's an Anthony Robbins thing, but constant and never ending improvement, and then have a good understanding of your ratios. So in a nutshell, we know, yeah, and I'm not telling anything you don't know here, but this typically is what has to happen in a farm every morning when you get up. Now I'll leave that up for a second, but because I'm not going to read it. You can very well read that, but all I know is I get up every morning and I know I start running to get ahead. That's it. Thank you very much.